Hey everyone, my name is Rulla. I recently ran a poll on Instagram asking my followers whether or not they were fulfilled living life to the fullest. And I was shocked and stunned to find out that 65% answered no, they're not fulfilled and they're not living life to the fullest. So I spent the next days responding to those who answered no, asking them why. Why aren't they living life to the fullest? What's stopping them? And the number one answer was money. I don't receive enough income. I can't save for the life of me. I don't know what to invest in. I don't know how to get started. And so I figured it was only right for me to come here on YouTube, film a video about how I started saving, what my investment strategies are, and how you can get started today. I'm currently enrolled in an online class, and I was recently asked the multiple choice question: where is the best place to put cash? A, your pocket. B, a safe or a pillow or wherever you hide your money. C, a savings account. Or D, an investment vehicle. Now, your first instinct might be to answer C, a savings account, right? It's a safe option. However, the best answer is D, an investment vehicle. And the reason for that is inflation. $100 today is not going to be worth $100 in 10 years. And that's why if you were given the option to receive $100 today or $100 next year, it'd be a best bet to get that $100 today and start investing it immediately. The truth of the matter is, minimum wage rises, costs rise, but your money will stay as is. And that's why it's important to place our money in a place where it can make money for us, and that way we have a return in the end and not a loss. Each day you're not investing, you are missing out on an opportunity to potentially make money. So now let's talk about my story. How did I get started? I came from a family who really invested in my future. When I was in first grade, my mom and dad took me to a local Bank of America and each invested $1,000 in a savings account that was put in my name. Now imagine having $2,000 at the age of 5. You would think that this made me want to just run and flee with the money, but actually it had the opposite effect. It made me really want to grow that account and see the numbers blossom. So the funny thing is, when we grew up and we all started getting our jobs, all my friends were looking forward to Friday because that's when they could cash their check. Meanwhile, I was excited to deposit the check in my account and see the numbers grow. Because my mom and dad put the responsibility of the bank account on me, it really made me see the value of money. And I was discouraged from withdrawing. My parents told me that there was a limit on withdrawing and that it was best to just keep the money far away from reach. Now, that isn't to say I've always been smart with money. When I was in college, I got my first credit card, even though my mom told me not to do it, and I discovered online shopping. The story goes downhill from there. Basically, by the time I had graduated college, I had almost drained my entire savings account. And it just made me really sad knowing that I had spent all those years saving. And when I looked around, I realized I hadn't spent any time investing, and there was no investment vehicles that were making money for me. Instead, I was using the money, losing the money, and I was left with almost no money. So after graduation, I decided that was it. I'm just gonna start budgeting. I was gonna start keeping track of all my cash transactions, spendings, and earnings. I was going to read as many financial education books as I could, educate myself, with different articles. Also, I had just started dating a millionaire who made one of his first breaks on Bitcoin, and realizing that I had the potential to invest in things and I didn't really made me feel like I missed out on a huge opportunity. And that's when I said, I've had enough, I'm gonna do this. And I spent 6 months paper trading, which is like simulation trading. It's like using fake money. And the nice thing is you can make a fake trade as if it was real, and you see the numbers either either grow or diminish based on your choices. And so after about 5 or 6 months of paper trading, I finally felt confident to make my first real trades. I deposited a few $1,000s in my first brokerage account, which I opened with E-Trade. Encourage you guys to do your own research on which brokerage to pick. I've heard many great things about TD Ameritrade, and they also have a $0 account minimum. So that's a great option if you don't have much money to start with. Since then, I've grown my account, I've dabbled with cryptocurrency, I've opened up a Roth IRA, and it's finally time for me to share with you guys what investments I'm currently in and just some extra knowledge that I believe will benefit anyone. So keep watching if you want to find out 10 different investment ideas and also some myths and truths behind investing in the stock market. Now, before you even start investing, you need to get rid of limiting beliefs. Just because someone in your close personal circle hasn't made money investing doesn't mean that you can't. A lot of people who just feel that the stock market is a gamble, which I'll touch upon later, and that it's just really not worth it. Meanwhile, these same people gamble at the casino, make horrible financial decisions, but they don't think that's a gamble. So, debatable. The next thing is, if you don't feel like you're good at saving, stop telling yourself that. Just because you haven't saved up until this point doesn't mean you can't start saving right now. Now, this video is mainly on investing, so I don't want to get too much into savings, but let me know in the comment section if you guys would like to see a video on how to save. And no, I'm not going to tell you to skip out on your daily coffee or something you love. I'm going to teach you how you can spend luxuriously on the things that you love and cut back on things that you don't care too much about. Let's talk about the 10 different investment ideas that I have for you guys. I'm only going to go in depth with the first two, so I'm first going to just introduce the 10 to you, and then I'm going to go more in depth on the top two since that's what I'm heavily invested in. So the first one is investing in individual stocks. Now, this is probably what a lot of us are familiar with when we hear people saying that they've invested in Apple or Amazon or any of those big publicly traded companies. Now, option 2 is investing in ETFs. ETF stands for exchange traded funds, and I'll get more into this in a little bit, but it definitely is a better option when it comes to diversification. The third option is cryptocurrency. The fourth option is real estate. The fifth option is trading options, which is basically making a prediction on whether a stock will go up or down. The sixth is investing in a 401k or a Roth IRA. Now, if your employer offers matching of 401ks, I highly encourage you to start now. If not, then I do encourage you to start a Roth IRA. I'm going to insert a chart right over here all about the difference starting a Roth IRA at age 15 versus 25 versus 35 and so forth. The seventh option is investing in Forex, which is basically investing on currencies. The eighth is investing in precious metals such as silver or gold. And options 9 or 10 are known to be the least risky, and that's investing in mutual funds or bonds. So like I mentioned earlier, I'm going to go more in depth on the top two. So the first one being individual stocks. Now, I feel like this topic is just very glamorized. So many people talk about trading individual stocks, although it is very risky. So investing in an individual stock has high potential for reward, but it also has high potential for risk. Let's say we have $10,000 and we decide to put all of that into Apple. Well, let's say Apple stock were to tumble. That means our entire $10,000 is going to tumble as well, right? So The risky thing about individual stocks is you're basically placing all your bets in one place. And doesn't it make more sense to spread your risk around a little bit more? That's what diversification is known as. Diversification just means you don't put all your eggs in one basket. Rather, you spread them out to spread the risk and also spread out the potential for loss. Number 2 is my personal favorite. It's one that's not talked about as much, and it stands for exchange traded fund. Now, I always like thinking of an analogy of a pizza or a pie. So in the first example, we have a pie and it's all going to one company, right? Whether it's Amazon, Apple, Home Depot, Costco, Target. All of these are companies we can invest in. What an exchange traded fund does is instead of having one pie or one pizza full of only one investment, it splits it up into smaller slices. So one piece can contain hundreds, if not thousands of stocks. A, you have less risk. B, there's also less reward. So let's say you have this pizza, this ETF pizza, and one of those stocks just crashes to the floor. Well, it's not going to make a huge dent to you, right? Because it's only one of the slices of the whole pizza. Now, in turn, let's say one of those stocks just boomed off and went to the sky. Well, same idea. You wouldn't have too much reward. That's just only one stock of the bunch. I really recommend ETFs for beginners, for people who are looking to invest long term. ETFs can track an index. So an example of an index is the S&P 500. I encourage you guys to do your own research, but basically the S&P 500 are the 500 biggest, most widely public traded companies, including the Amazon, the Apple, those ones that we discussed. Now the S&P tracks the trend of all of those companies together. And the nice thing about it is it gives you an idea of the overall market. If the top 500 companies are performing pretty well, then that's a pretty good indicator that the entire market is performing pretty well. If S&P 500 is going down, then most likely the overall market's going down as well. So you can find ETFs that split the pie up in terms of the S&P 500. You can also find some that track the Dow. You can find some that track the NASDAQ, which is more technology-based companies. I really encourage you guys to do your research, but the nice thing about this is the ETF is tracking a whole bunch of companies rather than just one. Now, another thing that ETFs could split their pie up is according to sector. Now, a sector is just basically like a category. So an example is healthcare. You can find healthcare ETFs that have one pizza split into a bunch of different healthcare companies. You can have an ETF based on financials, so they would contain companies such as Bank of America, Chase, JP Morgan, any of those financial institutions. You could find an ETF that tracks more tech-based companies. You could even find ETFs that track companies based on size. So there's small cap ETFs versus mid and large cap ETFs. Now you might ask yourself, well, which one do I choose, right? Number one thing I recommend is looking at charts. Depending if you're looking for a short-term or long-term investment, let's say you're looking for a short-term investment, well then you would track the stock price for a shorter amount of time, maybe a few weeks or a few months. And the thing you want to pay attention to here is previous highs and previous lows. Now, why are we interested in those? Well, previous highs act as resistance points. So a lot of times trends tend to repeat themselves, meaning if a stock has made a certain high, let's say $200 within the past 6 months, most likely once it reaches that $200, it'll start to dwindle again. Now, that isn't to say sometimes stocks will reach previous highs and they'll continue to rise, but it's a pretty good indicator that when a stock is reaching a resistance point, then it's usually going to go down. Now, the opposite is true as well. You can look at previous support lines, which is basically where the stock doesn't fall any further than that number. So let's say that number is $100. That's the support line. Well, you would know that usually when it hits around the $100 mark, it's going to start to rise. Now, this isn't always true, but this is a good way just to track previous trends. And like I said, trends tend to repeat themselves. So if you're looking to short-term invest, I would look at a range of a few weeks to a few months. If you're looking to long-term invest, then looking like at 5 to 10 year trend periods would be beneficial. The other thing that's important is how many people are trading. You can find this out in the volume. Obviously, the less people there are trading this, the less credibility there is. So I always like to find stocks that have a high volume of traders, meaning I'm not the only one investing in the stock. Now, the third thing is looking at financial statements of companies. You need to make sure that this company isn't in terrible debt, that their cash is increasing year by year, that they're making sales. All of these are good signs when it comes to financial statements. Now, this isn't always true, right? There's some companies like Amazon who were in debt for years and years and years before they made a profit. So this doesn't apply to every company, but it's just natural to look at financial statements and feel confidence in a company, knowing that they're growing, knowing that they're making higher income than previous years. That's going to give you more credibility when buying a certain stock. Also, some stocks will have risk and performance kind of gradings. I would look at those. Obviously, the ideal stock would be something that has high potential for reward and low potential for risk. So that's definitely the things that we want to keep our eye on. Also, kind of back to the whole volume thing, I never trade penny stocks. Penny stocks are stocks that are in the cent range or even in the few dollar range. So the big thing about these is they have a lot of fluctuation and variability. So I recommend trading stocks that are only trading at $20 or higher, which just means that the company's been around longer, there's more people trading it, and there's less potential for risk. Now I want to go over just some tips for newbies. The first thing I would do is, like I said, start with paper trading, start with simulation trading, start having different watch lists of companies or ETFs that you're looking at. Track those on a daily or weekly basis before you jump in. The other tip I have is start a brokerage account somewhere that doesn't have a minimum requirement. I believe TD Ameritrade doesn't have a minimum. I'm not sure. Like I said, I use E-Trade, but this is nice because it doesn't put pressure on you to have a certain amount of money in there. Also, quick little bonus tip, because sometimes people don't know this, just transferring money into the investment account doesn't mean you're trading. It's not until you actually buy or trade a stock does it mean that you're actually investing in a stock market. So for example, just transferring $500 from your account to the E-Trade account doesn't mean you've started investing yet. It just means that the money is there in E-Trade ready for you to invest at whatever point you want. So it's nice to have some money in your trading account at all times, just so if you see something that you want to jump on now, you don't have to wait to make that transfer, because it does take a few days generally to get it over from an external account. This goes along the same lines of paper trading, of studying, of researching. Also, just understand what you're investing in. Just because other people say that it's a good bet doesn't mean you should jump on the bandwagon. Always do your own research. Always study, always observe those financial icons like Bill Gates, Warren Buffett, Jeff Bezos, the people who know what they're doing. Also, be prepared to lose everything. There is no guarantees, so you shouldn't be putting money into an investment account if you need that money for rent, for food, for things you actually need to survive. This should all be extra money that you have on reserve that you really don't need at all. You've really forgotten about it, and now you want to see what you can potentially gain from it. But I always make any investment as if that money is already gone. The other thing is be prepared to hold an investment. Kind of goes goes along my last statement was don't invest with money you'll be needing soon. So be prepared to hold and be prepared to sell too if you see that you've made a profit and you want some liquidity. Another nice thing that a lot of people don't know is you can actually set certain percentages on your account. So when your stock or your ETF has reached a certain amount of growth, it will automatically sell it for you. So the nice thing about this is it really takes emotion out of the equation, because that's what gets people in trouble, is getting greedy, thinking a stock is going to continue to rise. Maybe it's at 20%, but you think it might go to 30 and then it just hits the floor. So sometimes it's nice having these indicators set up already where you tell the system, hey, as soon as I make 10%, just sell it. As soon as I make 15%, just sell it. Some people think this is like too safe, but others think it's a really, really good way to get your emotions out of the equation and to guarantee those profits, right? Because my motto is any profit is better than no profit. So it doesn't matter if you sold at 10% gain and it made it to 12%. Okay, maybe you missed out on 2% gain, but it doesn't matter because you've already increased your original investment by 10%, so it's a win either way. And the other thing I want to mention is a bearish market versus a bullish market. So if you think of these animals, it really helps you understand the market. Think of a bull. It's rowdy, it's strong, right? This is when markets are trending upwards. This is when there's a lot of people buying, when the economy is doing good. Right now we're in a bull market. Who knows for how much longer? But if you look at current stock prices, they're at their all-time highs. So that's definitely an indicator of a bull market. Now, bull markets are always followed by periods of bear markets. And bear markets is when prices are going down, people are selling, maybe the economy is tumbling, people don't have as much cash to invest. And these markets really go in cycles. So you'll have a bear market followed by a bull market, followed by a bear market, and so forth. So now I want to talk about the stock market myths. Number one being the stock market is a gamble. Such an extreme statement. My answer, yes, it is. But looking at previous trends, which like we said, trends tend to repeat themselves, on average, the market has increased 7 to 8% every year. Now, that means your $100 sitting in a savings account will probably make you a few cents, if any, whereas putting it in a market, whether it be an S&P, ETF, or even an individual stock, you're likely to make 7 to 8% returns annually. Second myth, buy companies you like and enjoy. This one's a big no-no. Now, I had this issue when I first started investing. One of my first stock picks was a company with the ticker symbol AJRD. And little did I know at the time, this company actually funds war, like weaponry, that whole thing. And right after I learned about that, I sold the stock because I don't support war and blah, 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 blah. I just looked at it on my watch list the other day and it's gone up like hundreds of percents, basically more than any other stock that I picked. So looking back now, was it smart of me to get my emotions involved? No, because at the end of the day, I believe financial freedom is gonna help you change your environment, is gonna help you change your community. So making an investment in maybe something that's not so ethical, I don't know, people feel differently about it, but I feel like as long as the gains I make, I'm gonna use in a positive, beneficial way, who cares what that other company is doing, right? They're gonna do what they're doing regardless. Me investing my $1,000 in there isn't gonna make or break their business. But the important thing is that the profits that I make from investing, I can use ethically, right? And I think that's important. Another funny story, McDonald's. It's a company I don't really support. I haven't eaten McDonald's in over 5 years, but guess what stock I recently bought? McDonald's, and it's performing really, really well. So this is another example of a stock that I personally don't like or don't have an emotional attachment to, but it's bringing in the results. So the important thing here is investing is not about what you like, what you enjoy. It's about what's making you money, and you really need to make that distinction from the beginning. Now let's talk about some of the truths when it comes to investing. So something I hear all the time is the earlier you start, the more risk you can take on and the more stock market crashes you can withstand. Now this is extremely true because on average, markets tend to crash around every 8 years. As you guys know, we had our big market crash in 2008, 2010, and it's been almost 10 years since then. That's why a lot of people are predicting a stock market crash, just because looking at previous trends, generally every 8 years we have a crash. So let's use an example. Let's say you start investing at age 20. And on average, every 8 years, the stock market crashes. So when you're 28, the stock market crashes. Well, you're still invested, right? You're not going to sell. You're going to keep it on. So generally by age 30, 31, 32, you'll have already recovered those losses. And when the next stock market crash hits at 36, once again, you don't need to sell yet. So you're in for the long haul. The end game here is you want to be in the stock market for as long as possible. So if you can start at age 18, do it. If you can start at age 20, do it. The earlier the better. Because let's say you do invest when you're 60. Well, what's the chance that there's going to be a stock market crash when you're 68? And by then you really need to sell because you need that money for your health, for a new home, for your grandchildren's college, whatever it may be. Generally, the older we get, the more access we need to our money. Whereas when we're young adults, we're already working, we're already grinding, we already have income coming in. So this is all extra to put away. So the best thing you can do is start now. Yes, you might face a few stock market crashes in your lifetime. That's bound to happen. That's normal. But the nice thing is you're going to withstand those bear markets, and when a bull market starts up, you can invest even more and get really discounted stocks at a good rate. I'm going to insert a chart right here of the S&P 500 trend over the last 100 years. Now you can see along that line, there have definitely been dips. There's definitely been times where it dropped. But overall, what's the trend? It's rising. And that's the truth of the matter, you guys, is as time goes by, things are going to cost more and more. Stocks are going to cost more and more. So yes, there are going to be pauses in that. There are going to be crashes and recessions during that time. But overall, it's rising. And that's just what the facts show. I really hope this introductory video helped you guys learn a little bit about different investment options, how I got started, and some general myths and truths about the stock market. Let me know in the comments below what you guys are currently invested in, and also some ideas for future videos. I know I definitely want to do a video covering short-term versus long-term investments. I also want to do a video on how to start saving without cutting out things we love. So thank you guys again for watching. Make sure to subscribe to my channel down below. Click the bell so you can be notified every time I post, and give me a thumbs up. There are not many young individuals talking about financial education, talking about investing, and I really think it's important. I think you guys should get started today because it's never too late to start, and I'll see you guys very soon. Mwah!